Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Welcome, everybody. Today is Monday. We've got another great show for you today. First, as always, we'll talk through some current events and some economic indicators with Ben here in a moment. After that, we have a guest with us, Olivia Delancey from Optimal Blue. She is the host of our Market Advantage podcast. So we'll talk a little bit with Olivia, and she was also at the HousingWire Housing Economic Summit with me and a few others last week. So we'll talk through some really cool topics that we covered there in our session, but also some interesting sessions that we attended at that really good conference last week. Just a little bit of data to talk about this morning. The OBMMI, so the conventional 30-year, is approaching 6.5, so around 6.6 right now. So the lowest we've seen so far this year, and that's definitely been driving volume. You'll see in our daily market briefing that we're seeing volume levels about on par with what we were seeing pre-pandemic, so 2019 levels, which was a pretty healthy year, if you recall. So encouraged by that, continuing to see rates hold.
Yeah, so down about half a point, almost half a point from the highs at least. We had peaked early mid-January at over 7%. So trending in the right direction, certainly. So, between rates moving in the right direction and probably a little bit of seasonality, as well as no natural disasters here over the last several weeks, probably some stability in that regard. So all those things kind of helping us trend in the right direction for volume is good news.
Yeah, there was an overwhelming theme at the conference last week that 6% is the number. The closer we get to 6%, you really start to see activity pick up, not just in refis, but in purchase volume as well. It's just kind of I think some of it's psychological, but some of it's also math. I think loans become more affordable at that point for buying a new home, but you also see some of those 7.5 interest rates interested in trading down. All right, let's go check in with Ben, see what's going on in the world. All right, welcome, Ben. Resident Oracle on the desk here to talk a little bit about what's going on. I mean, it's unemployment week, always an exciting week in terms of all the data that surrounds that. What else is going on?
Yeah, not too much other than that. We will have ADP payrolls this week, the less important cousin of non-farm, and then ISM services Wednesday. But I think a lot of the headlines might somehow gravitate towards Canada, Mexico, and additional China tariffs that seem set to go into effect. We'll see if there's a last second change to that. And maybe there's some negotiations happening as we speak here that maybe those won't go into effect, and maybe we'll see some market moves off of that. But yeah, that jobs report next week, we have February's CPI and PPI. So those will be the big things to keep an eye on for this week for sure.
All right. So what are we expecting? 160,000 jobs? Does that sound about right? So a little above where we came in last month.
Right. Yes. So pretty solid number still. There's definitely a varying consensus. One thing we do know is unemployment could tick up a little bit. We hope wages are cooler than they were last month. It seems likely that they will be. If not, that could be an issue for sure. The Doge cuts that we've seen are unlikely to be reflected yet. I think a lot of that's going to happen, potentially in the next report. So once we're looking at March's report in early April, or even beyond that, just depending on some of the technicalities of those job cuts. But February is typically a strong seasonal adjustment downward because state and local governments tend to hire more in February, kind of coming off of the slower winter holiday months. So there actually tends to be a pretty strong downward push that you get from that. So we'll have to see what it looks like. I know Jeffries, for example, I think was calling for well below that 160K number. So we'll see how it shakes out early on Friday morning.
All right. Yeah. Still, at least in the private sector, in the more white collar type jobs. Still a difficult market, but if that number stays around 4%, the Fed doesn't really have any reason to move.
Right, exactly. And as we're kind of going to touch on here, when we look at some of last week's data and some things that are going on, it seems like the inflation side of the equation is going to keep them on hold potentially. Mm-hmm. We'll see. We hope we're wrong. We did get PCE that came in last Friday. It came in at 2.6% year over year, 0.3% month over month. I believe it was actually like 0.26% month over month. Of course, they round that off. So maybe a little bit better than even that number indicates. But even within that, personal incomes were higher than expected, even though personal spending actually dropped 0.2% or 0.5% drop if you account for inflation. So some signs the consumer is pulling back, yet we still have these inflation readings that are running quite hot. So yes, kind of we're in a little bit of a weird spot. I don't want to say the word stagflation. I mean, I guess I just did, but signs of a slowing economy while prices continue to run a little bit hot, which is not ideal.
No, it's a brutal economic situation to be in. I know, Japan spent many years in that situation, and obviously, with very little growth, but just rising prices. There's no fun there.
Right. Yeah. It's kind of the worst of both worlds. Yeah. I guess the good news is inflation. I don't think we're going to see inflation jump to 8% again, or even above that. Like, we're just kind of sticky here, 3, maybe a little bit higher percent. So it's not like super high inflation, but certainly above the Fed's target. And we'll see how constraining that is in allowing them to cut rates. Like, are they going to try to cut rates even if inflation does remain a bit above target here? It's certainly on the table. So
I think I saw one of the main kind of lagging components of some of the inflation numbers is rent, or what do they call it?
Owner's equivalent rent.
Owner's equivalent rent, right? And that's still a little bit higher, but I think there's, we can tell across the economy just from, as we talked about in the intro, rates starting to decrease, some other factors. I don't think we'd be surprised if, rent increases start to slow here coming. So as a lagging indicator, right, that's good news and supports the fact that inflation will continue to come down here.
Right. Yeah. And that's something I think that gets lost in a lot of talk about tariffs, is that's mostly going to affect goods that we import. And so you really got to look at inflation, like how much of inflation is goods and goods that we import. It's really not a massive amount. So you really got to look at rent and owner's equivalent rent and some of these things that are a pretty large weight in the CPI and PCE index. So yeah, that's a great point. Rent, like if you look at live rents and their various measures of that, like what current market rents are, like they've come, I don't want to say they've come down everywhere, but they've cooled off of their growth rates, right? Like have basically gone, less than inflation here for a while. It's just the methodology within the rent measurement and owner's equivalent rent is lagged out because not everyone is renewing their lease at one time. So we're still seeing rent increases that happened a couple of years ago filter through into the data. So yes, over the next year, we should continue to see those measures trickle down. That should continue to help us. It's just taking quite a long time for that lagging indicator to hopefully help us out there.
Yeah, that's good news. And obviously it makes a lot of sense. Again, with the labor market being soft in certain areas, the average consumer is overextended at this point in terms of credit. So we're spending is slowing down, and it didn't make sense to go on infinitely just paying more every time you sign your lease, a higher percentage of rents going up. So it does feel like we're seeing that start to flow off.
Right. Yeah, definitely. Good news there. I know anecdotally in Denver, I think Denver's got a ton of new units that have been built, and I think rents have outright dropped in Denver. And right now is kind of the bottom. So if you're looking to rent, it's probably a great time. Or if you're shopping for a house and you got to compare that to what your rent might look like, the rent is probably looking really attractive right now. So again, that'll continue to filter through. But yeah, we look on kind of the consumer sentiment side. It's hard to put too much stock in some of these numbers because I think a lot of it is survey based, which you always got to put an asterisk on. But multiple readings last week that were quite weak, both the Conference Board, the University of Michigan, and then even within that PCE release, a lot of concerns about consumer sentiment and spending data, which the consumer is a massive part of the economy. So definitely highlighting some concerns around growth. And that's really why we've seen this rally over the last few weeks. And Atlanta GDP Now tracker, is now showing a negative 1.5% real GDP growth rate, which I think a couple caveats. It tends to be very volatile. And we've seen you can see some weird headlines off of that too. So I don't want to put too much stock in it, but definitely highlights a pretty sharp downward revision in growth, at least in that tool. It should become more accurate later in March. As we get towards the end of the quarter, it should get close to what we're actually going to see GDP come at, but it was at 2.3% before. So it saw a massive revision just this last week. Yeah. Fell off a cliff. So again, don't put too much stock in it, but certainly kind of highlights the overall growth concerns. And that does have the market at least thinking we're going to get a couple cuts this year. Again, we'll see if the inflation picture allows the Fed to cut 2 or 3 times this year.
Just looking at the CME rate watch futures, we're up to about 33%, thinking that there will be at least one cut over the next 2 meetings by May 7th, which is up from even a week ago. We were at about a quarter about a week ago. So starting to trend in that direction of what you just mentioned, Ben, certainly.
Yeah. And I think the probabilities are suggesting like June could be the first shot, then maybe again in September, and then a little bit of potential for a November, December. But we know those odds move quite a lot. So we'll see. I think we'll have a totally different picture come non-farm payrolls this week and then CPI next week. And yeah, hopefully, at least for the mortgage industry's interests, that rates kind of at least hang in there as long as we don't give back a lot of this rally. That I think would be good news, even if we don't rally substantially further.
Yeah, just a lot to think about right now, but it does feel like we're turning a corner somehow. And you got to wonder how much of it is a self-fulfilling prophecy, back to your point about consumer confidence. But the consumer being, I think the number's roughly 60% of GDP. Mm-hmm. That's a major influencer that could take us from being positive to being negative if we suddenly stop spending. And on top of that, if we start losing jobs, and those two can be correlated as well, right? If we stop spending money, businesses don't do as well and have to lay people off. So it feels like the second half of the year is a bit of a wild card, especially in the context of some of the chaos of the new administration and tariff talk and other ways that the new administration is trying to shock the economy into hopefully good things, but making some major changes right off the bat here in this first quarter.
Right. Yeah, it'll be interesting to see how it plays out. Even just the thought of job losses can keep people on the sidelines, can keep businesses on the sidelines of, okay, where's this economy headed? And if enough people cut back on spending or hiring because of that, then, that can certainly lead to a recession.
Right.
We'll see how the jobs report comes out this Friday and see where we're at.
Sounds good. All right. Thanks so much, Ben.
You bet.
Okay. As promised, co-host of Market Advantage podcast, Olivia Delancey, welcome.
Hey, Jim. Hey, Jeff. It's great to be here. Thanks for having me.
Thanks for taking some time on Monday morning to talk with us. As I mentioned, Olivia and I attended the HousingWire Housing Economic Summit in Dallas last week. It was a really well-made production, I thought. It was a full day, and it was wire to wire at the George W. Bush Institute there on the SMU campus. Really good
presidential
group.
It's a pretty cool spot.
I did not get a chance to actually go to the museum part, but I guess that'll bring me back at some point. Yeah, really good crowd. I'd say, 200 people.
Seems like a reasonable estimate. Yeah. It was full for the venue. It was full. So great crowd.
Yeah. Really good crowd. Good mix of different roles. Got to meet a lot of people in the morning and then at lunch and then at the little happy hour after. But the rest of it was just 15 to 20 minute to 25-minute sessions, depending on who was speaking, and a couple longer ones at the beginning.
People from all over the housing industry, right?
Yes. Yeah. It wasn't just mortgage people. It was, insurance, realtors, brokers. It was, mostly it was residential. I'd say was the only line that was drawn. It was residential real estate, but otherwise, yeah, really good mix of people talking about a lot of different things that all revolved around housing finance, the housing market, and some of the other factors that affect what's near and dear to all of us.
So what were some of the highlight takeaways from you beyond your session?
I mean, so at the very beginning, so Logan Motoshami is the lead analyst for HousingWire, and he set off the day really nicely. He's a great presenter and just has some really good takes on what's going on in the economy and what's going on, especially as it relates to the housing market. And some of it's controversial, honestly, which I thought was pretty refreshing compared to some of the, I think some of the more sterile takes that we all might have on the industry, especially with the market being a little bit, quiet chaos right now. I'd say, some highlights were, one was there was a theme across the whole day, which was 6% is the rate that we all would like to see, or something close to 6%. And we're seeing that even right now, as we mentioned earlier on, with the OBMMI getting closer to 6.5% and drifting hopefully lower than that. We're seeing volume really pick up. So there was a consensus that if we get to 6%, that unlocks quite a bit of refis for obvious reasons, right? There's a ton of 7+ interest rates out there right now because of what's going on the last couple of years, but also should open up the purchase market a little bit as well, whether it's builder business, being able to buy down rates even deeper than 4.5-5% that they're doing now, or just to open up for making purchases a little bit more affordable.
Yeah, right now with house prices, essentially becoming stable, right? Starting to see a slowdown in home price appreciation. So that's not going to hurt affordability probably for the foreseeable future. So, but, with insurance costs rising and then just high interest rates, those are the biggest drivers of home affordability right now. So if we can help that with lower interest rates, kind of stating the obvious there.
Right.
Well, one of the sessions, so Selma Hepp from CoreLogic, who's chief economist over there, and also our next guest on the Market Advantage podcast, she gave a really interesting presentation at the Housing Economic Summit on that exact topic, Jeff. The factors that are factored into affordability are changing, and property taxes and homeowners insurance specifically were the focus of her presentation. And as somebody who's a little less versed in these topics than you two would be, or most of the people in the audience may even be, I found it very interesting that a lot of the homeowners insurance risk was kind of concentrated in the center of the US. So in what she called Tornado Alley, which piqued my interest. I grew up in Nebraska. She talked about wind and hail claims are some of the most common. And I wonder if very many people realize that, you always associate wildfires, hurricanes with some of this rising cost around homeowners insurance. So that was a really interesting takeaway for me.
Agreed. Yeah, it's insurance is becoming such a bigger part of affordability, like we've been talking about here, right? And yeah, I figured the same. Wildfires here in Colorado on the West Coast, and then obviously, the hurricane areas of the country like Florida is what you think of, but you don't think about, I guess, Tornado Alley as much. But that will be, that becomes an issue when it becomes an issue during that season. I also thought Logan's take on generally what's going on with the new administration and the economy was interesting. And this is where it gets mildly controversial. He pointed to residential construction jobs as a leading indicator of recession, as an indicator of recession. So I thought that was interesting. That's something you can get easily off the internet. You can go back in time and see how that has corresponded with the last few recessions that we've had, and that we are seeing a little bit of a plateau in residential construction hiring. So that's an indicator that I've been watching now since the event. And also, we talked a bit about the potential mass layoffs at the federal government level, and that just generally how this new administration seems very focused on lowering rates somehow, right? Whether, it doesn't seem like the strong arm approach is going to get rates lower, but there is this issue of affordability with homes and just generally rates being high, and that kind of putting the brakes on a lot of economic activity. I think Logan's thought was maybe the government's fine with higher unemployment. In fact, they might be motivated to push the unemployment rate up over 4.3, 4.4%, where it triggers the Fed to say, okay, we're lowering rates, whether that's, a quarter at a time over this next year and a half, or whether, that we get up closer to 4.5 and there's some kind of emergency cut or larger cut. So maybe the government's okay with layoffs at the federal level, especially because the economy is still very strong, the private economy. So, those layoffs of government employees maybe doesn't, in their mind, there's almost no downside to it, which again, that's a bit myopic way to look at things, but just an interesting take on what might be going on with the new administration.
Yeah, depending on which side you're on, that's either a nefarious take or a pragmatic take.
Right. Could be totally practical.
Right. Yeah, that's an interesting way of looking at it. Definitely didn't think it like that. But as we always talk about on this podcast, the two numbers the Fed watches being unemployment and inflation. And so, unemployment is kind of one of those levers.
One theme that kept coming up was plan for the known. You have the known unknowns and the unknown unknowns. Jim, any takes there?
I kept having trouble keeping that phrase straight. So,
well, as I just stumbled over it, clearly I do too, huh?
I think everyone on stage did too. But yeah, I totally get that. There were a bunch of good sessions, and that came up in I think the session right after Logan's, which was Ryan and Brian. I'm sorry, no, it was Mike, another data guy from the HousingWire, and it's kind of keep an eye on what we know we don't know. And then the things we're not expecting, I think is the point there, right? And, back to just economic policy of the new administration. I don't know if it's because I look at it through the lens of a mortgage person, but now I'm really starting to pay even more attention of any kind of policy decision that comes out. How could it affect interest rates? And is the intent of that policy to indirectly lower interest rates? That there's a huge unknown there. But I'm more focused on that after that first session, just thinking through how lower rates and lower fuel costs, right? That was the other thing that Logan mentioned and other economists have mentioned. If you can get those two things lower, you may be able to keep inflation under wraps, right? Keep prices from going up, but also encourage economic activity and make housing more affordable without having to make any major policy decisions that directly affect like the housing industry or the GSEs or whatever, right?
That was an enlightening way to think about it, but it fits in with everything you've heard, right? Bessent continues to say those two things are his focus. And so, starting to read the tea leaves about how they're going to get there is pretty interesting.
Yeah, it's like perfect. If the economy can stay strong, but unemployment goes up, like for interest rates, that is perfect. If the economy is not hurt by these layoffs.
Olivia, what were some of the highlights for you of the conference?
Overall, so this was my first time attending one of HousingWire's summit events. So these are kind of their one-day deep dive events onto a particular topic. So for example, our Chief Technology Officer, Seaver Suleiman, spoke at the AI Summit last year. But this one was all about economics, housing economics, as Jim mentioned. Overall takeaway, people showed up to learn. Everybody had their notebooks, whether digital or handwritten. They were very engaged with the sessions. Sometimes you see people having hallway meetings and not attending sessions at events. That was not the case here. Everybody was fully engaged in their seats, ready to learn. And I think one of the things that lends itself well to that is the format that HousingWire uses at these things, the more quick fireside chat, 20 to 30 minute sessions. It was all really good. But one session that stood out to me was a little bit different than the others, and it was focused on refining your tech stack for success. And I think that kind of backs into that. There's the known unknowns and the unknown unknowns. This is maybe a known unknown. We know eventually the market is going to change. So what should you be doing in your house to get your tech in order in the meantime? And of course, Optimal Blue is a tech provider. So this piqued my interest. And one of the panelists was Christy Sukamnet, and she is Chief Lending Officer at University Federal Credit Union. Fun fact, Christy actually did a session in partnership with our own John DiMonso. He's one of our PPE solutions specialists. This was back at the ACUMA, the credit union annual event in Vegas last year. So I recognized Christy, but she was a great panelist. One thing she said was, talk to your vendors. Your vendors are there to be your partners, and lean on them to make sure you are using your tech to its fullest, because I mean, we are in a period of massive innovation. Companies are just rapidly releasing new features, new products. As a testament, Optimal Blue, we just announced 7 new product features just a few weeks ago. So as these vendors are innovating at such a rapid pace, how are you as a user making sure you're getting the absolute most out of these products? And that was really her counsel, was sit down with your vendor, talk about what you're using, talk about how you could maybe be using it differently based on your own business goals. And, at Optimal Blue, I don't think I could have been shaking my head, nodding more enthusiastically as she was talking about this, because that's something very near and dear to us. We have kind of a business relationship manager and a client success manager dyad structure where we are sitting down with clients proactively, showing them what they're using and recommending things, ways that they can use it more effectively to help their operations. So I really liked that session. I'll leave all of the commentary on market matters and economic matters to you, Jim, but that was something that stood out to me.
Agreed.
Yeah, that's great to hear. I mean, obviously, I'm very passionate about that topic, and it is a huge focus for us, especially this year as a tech vendor, making sure our clients are utilizing all the great, as you said, we are developing at a rapid pace. So, I already feel like things that we released in the fall, people have already kind of forgotten about it. They haven't adopted it yet. Then, we want to make sure, they still remember the things we released 6 months ago and they do get a chance to adopt it. So, that's good general advice. Everybody has numerous tech vendors, and you got to make sure, you're taking advantage of all that, as you said, so that, when volumes increase by 50%, you're not trying to implement new solutions while also you've got these solutions in place that help you, process those increased volumes. So,
right. And lean
advice.
on the experts who work at these shops. I mean, you two, case in point, you've worked in the business, you're so familiar with some of the challenges that they're facing. Like, what a perk of working with a vendor who has so much in-house expertise that they can help you really maximize the use of your tech. So
yeah, I mean, and Christy brought receipts. Like, they had, I believe she said their cost to produce a loan is down to about $9,800. I think is the number that I heard. In an industry where the average is about 12.5. So they're obviously utilizing technology correctly and to make themselves more efficient. So not only can they scale without adding a ton more people, but it sounds like they've also lowered their costs just in general. And as a credit union, that's not always the case, right? They're not always that focused on cost.
Right. So now they can offer the service and the competitive rates, which, again, offering a more competitive rate, affordability, top of mind for everybody. So you can lower costs.
Right. So I moderated a session with Victoria DeLuce, who is SVP of Finance at Rate.com, and also Morgan Wise, who is the CFO over at Atlantic Bay. Really good session, really good wisdom dropped on the whole group there. We were there as capital markets mortgage experts in a room. Again, as I mentioned, it was a lot of different roles. So we brought just things specific to the mortgage industry. We covered some of the facts that were brought up earlier and some of the theories about what, the 6% rate and what gets us there. And mortgage spreads, we talked a little bit, educated the group a little bit on what affects mortgage spreads, right? So the spread between mortgage rates and treasuries. And then we got into really getting a little bit deeper into profitability and how can lenders get more profitable in a market that's been pretty tight, albeit a little chaotic over the last couple of years. And we talked about some of the simpler things, again, knowing that in the room, there's probably business owners, head of finance, some folks that may not even dabble in capital markets, educating on things like being sure that you're delivering mandatory, for instance, that you're hedging, right, rather than best efforts, because there's a quarter point to 3/8 of a point of pickup there that can mean the difference between being profitable and not in a tight market like this. We talked about very proactively managing your margins. I think there's still way too many lenders out there who leave their profit margins on autopilot, and they're probably not as competitive as they could be in some MSAs or some product groups, and maybe a little overly competitive in others, leaving some money on the table. So we talked through how you can use data such as the data that we have in Optimal Blue to drive those margin decisions and to be more deliberate about how you set your street price.
that kind of goes back to honestly the previous conversation as I think about some of our tools, of course, but so much of this technology allows you to automate so much, but it doesn't mean setting it and forgetting it, right? It's opening up your time to be more strategic, to focus on more of these strategic items.
And strategy could also include liquidity. That was the other thing we brought up, where Victoria had some really good points on, as you mature through, you go from best efforts to mandatory, and then you move towards delivering directly to the GSEs. Don't just stop there, and don't leave your aggregators in the dust when you move to co-issue or wherever your strategy takes you. You really have to have all those options open to you as a lender.
Nice. Yeah, those are themes we're all very passionate about. And, I think it makes sense. It fits in really nicely with what we're looking ahead to. I'll give it a shot here. Some of the known unknowns and the unknown unknowns.
You got it.
Yeah.
Nice. Agreed. Yeah. Keep all your options open and make sure that you're focused on who your counterparties are, and you're constantly relooking at that. And you're also looking at your own strategy and your bottom line. Morgan brought up some great points just about, knowing what your profitability is, down to a loan officer level, down to a product level, down to the branch, right? So you're sure you're kind of feeding the profitable parts of your business as opposed to maybe dragging some weight that needs to be improved upon.
Good.
All right,
that
good.
Sounds like a great conference.
Yeah, as far as like one-day conferences, that was very efficient, super educational. A lot of themes kept coming up, so there's obviously a lot of good consensus in the room. I don't know, anything else you would add, Olivia?
Nope, I'm just going to keep practicing saying known unknowns and unknown unknowns.
Yes.
We're getting good.
It's going to be the deal for the next few years here, I'm afraid.
Yes.
All right. Thanks you very much, Olivia.
Thanks, Olivia.
All right, let's close this thing out. Thank you so much, Ben, Jeff, and of course, Olivia, for another great podcast. Tune in next week. We will have Rob Crane from Down Payment Resource. We'll talk, Kevin and I will talk with Rob about what Down Payment Resource does and just getting into the whole huge world of down payment assistance programs that Down Payment Assistance Resource can help organize and kind of curate for you. So looking forward to that next week. And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thank you for tuning in to Optimal Insights.